Committee will come to order. Without objection, chairs are authorized to declare a recess of the committee at any time. This hearing is entitled International and Domestic Implications of De-Risking. Before we begin, I'd like to thank the witnesses for appearing today. We appreciate your participation and look forward to the discussion. I now recognize myself for 5 minutes to deliver my open statement. This subcommittee has spent significant time analyzing the impact of de-risking on consumers, businesses, and entire communities. As we've discussed, the overly punitive supervisory and examination tactics employed by federal financial regulators that came in the wake of the financial crisis have had dramatic implications on the availability of financial products and services in all of our communities. What we have not discussed are the global implications of these regulations. Today, we will not only explore de-risking's impact on U.S. financial institutions and their customers, but also its impact on people and businesses around the world, as well as our fight to combat illicit financial activity. Banking relationships with so-called high-risk clients have become cost-prohibitive for financial institutions, due in large part to heightened compliance expectations. As a result, many institutions have opted to terminate relationships. This decision has resulted in elimination of consumer and small business access to financial products and services, a decrease in the availability of money remittances, and reduced flow of humanitarian aid globally. To be clear, there are valid reasons for account terminations, and the fight against illicit finance is one of the most important fights we wage. However, we would be better equipped to wage that fight if we had a modernized regulatory system. That's particularly true in the case of compliance with the Bank Secrecy Act and anti-money laundering laws. The truth of the matter is that compliance with BSA/AML is so costly and the penalties so steep that financial institutions would soon rather end customer relationships than run the risk of running afoul of the regulators and law enforcement. The status quo doesn't foster a safer system, and it doesn't necessarily help catch more bad actors. In fact, it's quite the opposite. Instead of fostering collaborative relationships between institutions and government, the modern BSA/AML framework, along with the other regulatory drivers of de-risking, push more people and more money into the shadows. So where do some of those debanked customers go? According to data published last year by payment and compliance technology company Acuity, correspondent banking relationships with Chinese banks surged more than 3,300%, from 65 in 2009 to 2,246 in 2016. There was a 25% drop in the number of correspondent banking relationships globally during the same time period. It is in the best interest of our financial services firms, our communities, law enforcement, and the federal government to monitor and maintain these global banking relationships. This hearing isn't only important to the people testifying today or to the financial institutions that do business internationally. It's important to any small nation that relies heavily on the U.S. dollar and the trading partners who sell U.S. goods there. It's important to border communities that are losing banks and credit unions because of the BSA/AML regime. It's important to a worker in Florida who can no longer send the money he earns to help his family in Haiti. This is an incredibly important topic. We have an excellent panel today, and I want to thank each of them for taking time to testify. We look forward to your statements. The chair now recognizes a gentleman from Missouri, Mr. Scott, who is subbing for Mr. Clay, the ranking member of the subcommittee, for a 5-minute opening statement.
Thank you very much, Chairman Lukemeyer, for organizing today's hearing, and to each of our outstanding panelists for this testimony. We're looking forward to hearing from you. First of all, it's clear that the push by depository institutions' decisions to de-risk and discontinue account services for certain customers is having a very significant adverse consequences on a broad range of consumers, industries, and regions around the world. And in addition to the devastating regional impacts, the de-risking of broad categories of customers' accounts has also had an impact on key consumer groups that performs essential functions in our society. This includes nonprofit organizations, charities, embassies, and remittance providers, among others. Although the adverse effects of de-risking are clear, what's less apparent are the specific factors and the degree to which each factor is responsible for arriving at this trend. We look forward to the hearing. Hopefully we can come up with some very good recommendations as to how we go forward. Thank you again to each of the panelists for being here, and I yield back the balance of my time.
Gentleman yields back. Today we welcome the testimony of Mr. Michael Clements, Director, Financial Markets and Community Investment, U.S. Government Accountability Office. The Honorable Sue Eckert, Adjunct Senior Fellow, Center for a New American Security. Ms. Gabrielle Haddad, Chief Operating Officer, Sigma Ratings Incorporated. Mr. John Lewis, Senior Vice President, Corporate Affairs and General Counsel, United Nations Federal Credit Union, and on behalf of the National Association of Federally Insured Credit Unions. And Ms. Sally Yearwood, Executive Director, Caribbean Central American Action. Each of you will be recognized for 5 minutes to give an oral presentation or testimony. Without objection, each of your written statements will be made part of the record. Just two quick housekeeping things. Number one, we've got votes called probably around 3:30 to 4. If we'll see where we are with our witnesses' testimony and our questions, but we may have to ask you to stay a little longer if we need to go vote and come back. In the meantime, the timing system on your microphones there is such that green means go, yellow means you got about a minute left, and red means your time is up, and so we need to wrap it up very shortly. So with that, Mr. Clements, you're recognized for 5 minutes. Excuse me.
Chairman
Yes,
Luetmeyer.
you're recognized for 5 minutes. I'm sorry.
Chairman Luetmeyer, Mr. Scott, and other members of the subcommittee. I'm pleased to be here today to discuss our recent reports discussing de-risking by depository institutions and the implications for the southwest border region and money transmitters serving fragile countries. My statement today focuses on 3 key findings from our reports. As background, the Bank Secrecy Act serves an essential function. It helps prevent money laundering, terrorism financing, and other criminal activities. We define de-risking as a practice of depository institutions limiting services or ending relationships with customers in response to perceived regulatory concerns.
Mr. Clements, if you could move the microphone, just pull it right in front of you and just take a bite at it when you speak, it'd be great.
Okay.
Thank you.
Our first key finding, the extent of and reasons for account terminations and bank closures in the southwest border region. We found that branch closures in the southwest border region were concentrated in a small number of communities. 5 counties in Arizona, California, and New Mexico lost 10% or more of their branches. In some instances, those losses were concentrated in smaller communities. For example, one California town lost 5 of its 6 branches. The loss of bank branches can have negative implications for business lending and ultimately employment in these communities. In many instances, banks limited service or terminated accounts in response to legitimate BSA concerns. The southwest border region poses a high risk for money laundering because of the high volume of cash transactions, number of cross-border transactions, and number of foreign account holders. However, we also found evidence of de-risking. In particular, 80% of southwest border banks reported limiting or not offering of accounts because the customer type drew heightened BSA regulatory oversight. Here, the reason is perceived oversight, not the customer's action. Our second key finding, the challenges money transmitters face remitting funds to select fragile countries. We examined the experience of money transmitters serving 4 fragile countries, Haiti, Liberia, Nepal, and Somalia. Remittances from the United States are an important source of funds for these countries. All 12 money transmitters we interviewed that serve these countries report losing some accounts with banks. In the case of Somalia, 2 of 4 money transmitters report losing all access to bank accounts. Some banks acknowledge closing and denying accounts for money transmitters. These banks consider money transmitters high cost and also high risk customers. In particular, banks cite 1, high staff and technology cost associated with BSA-related activities, and 2, the perceived risk of significant fines and penalties. Money transmitters that lose access to banking services often resort to non-banking channels, such as couriers physically transporting cash. For law enforcement, non-banking channels provide less transparency and thereby hinder the ability to detect criminal activities. Finally, our third key finding, agencies' efforts to assess and respond to de-risking concerns. Treasury and federal banking regulators have taken some steps in response to concerns about de-risking. The agencies have issued BSA guidance to banks. The agencies have also conducted retrospective reviews. These are a look back to assess whether regulations should be retained, amended, or rescinded. However, we found the agencies' reviews have not fully addressed the factors that influence banks to de-risk. The agencies also recently began collecting data on international remittances from banks. However, we found Treasury does not have the data it needs to assess how the loss of banking services by these remitters will influence service to fragile countries. Given the problems we identified, we made several recommendations. We recommended that Treasury and the banking regulators conduct retrospective reviews that incorporate banks' regulatory concerns regarding BSA AML compliance. We recommended that Treasury assess the extent to which remittance flows through non-banking channels may hinder its ability to monitor criminal activity. Chairman Luetmeyer, Mr. Scott, and other members of the subcommittee, this completes my prepared statement. I would be pleased to respond to any questions you may have.
Thank you, Mr. Clement. Yields back the balance of his time. With that, we go to Ms. Eckert, recognized for 5 minutes. You're welcome.
Thank you, Chairman Luetmeyer, Congressman Scott, and distinguished members of the subcommittee. Thank you for the opportunity to testify today on the international and domestic implications of de-risking. I applaud your efforts to call attention to the critically important phenomenon of de-risking, something that is not well understood but which have profound impacts on some of the world's most vulnerable populations. The U.S. has a unique role to play in addressing de-risking globally, as the dominance of the U.S. dollar and American regulatory policies set the stage for other countries. My comments today focus on the impact of de-risking on charities and nonprofit organizations, and it's based on the research that I conducted for the February 2017 report, Financial Access for U.S. Nonprofits. It was commissioned by the Charity and Security Network and supported by the Bill and Melinda Gates Foundation. While I'm currently involved with the World Bank ACAMS process on financial access for NPOs, the views expressed today are my own. I spent a number of years on Capitol Hill as a staffer, in the executive branch as a regulator of dual-use exports, and in the academic community. But in all those years, there is no issue that I dealt with that has more serious, real, and dire consequences for populations in need. The severe implications extend beyond NPOs and the groups that they serve. It also extends to U.S. security and foreign policy interests. So with my brief time, I want to make a couple points. First, there is no question of the need for humanitarian and development assistance today. It is a profound need. The United Nations estimates that in 2018, more people than ever before will need assistance and protection, 136 million people. Conflict, protracted crises, and natural disasters continue to be the main drivers of need, which remains exceptionally high levels in countries such as Nigeria, South Sudan, the Syria region, and Yemen, which are likely to remain the world's most serious humanitarian crises. To effectively respond to these humanitarian crises, funds must be able to move across borders in a timely and predictable fashion. Financial access for charities and NPOs, therefore, can literally mean life and death. Secondly, there is no question that de-risking or problems with financial access for NPOs is having a serious and widespread effect. The study from 2017 noted, surprisingly, that 2/3 of all U.S. NPOs were having financial access difficulties. Perhaps more worrisome was the fact that in order to respond and get the aid to these places, 42% of NPOs were starting to carry cash because they could not get money through the financial system. We actually have more recent data that shows that the problem appears to be worsening. Third, the problem relates to concerns by financial institutions for the risk and cost associated with banking the charitable sector. This derives from well-intended and important policies developed immediately after 9/11 by the FATF, whereby NPOs or charities were considered particularly vulnerable to terrorist abuse. Based on more recent analysis, the evolving nature of the terrorist threat and actions that the charitable sector has taken, That perception is outdated, and in 2016, FATF changed its policies. However, the pervasive nature of the perception that charities are high risk persists. Serious unintended consequences of these policies have resulted. Fourth, de-risking is a complex problem that entails a variety of interests: financial integrity, national security and counterterrorism, foreign policy, and the provision of assistance, humanitarian and development assistance. And it must be a shared responsibility. No one group, U.S. policymakers, U.S. regulators, financial institutions, or the nonprofit and charitable sector can address these issues by themselves. Fifth, in terms of what kind of action should be taken, very briefly, raise awareness and promote a balanced approach. The stakeholder dialogue, which the World Bank and ACAMS has promoted, has enhanced engagement among all parties. What's really interesting is how little these sectors know of each other. The second is to provide regulatory and policy guidance. The government needs to develop policy and regulatory guidance that provides clarity to banks and NPOs on the implementation of a risk-based approach. However, 2 years ago, when the FATF adopted the recommendation, changed the nature of how charities should be treated, nothing has happened subsequently. Banks have told us there is no question that they have to have something from the regulators in order to change their assessment of risk. Currently, the World Bank and ACAMS initiative has produced recommendations that were jointly made by banks and nonprofits, which is pending before the regulatory agencies. Third, we need to explore incentives for financial institutions to bank NPOs. A menu of measures, including the creation of safe harbor to incentivize banks to keep NPO accounts and encourage efforts to engage with NPOs, should be developed. Finally, the creation of safe payment channels. There are times when banks are not going to go any further, and we need to consider those options. There are additional recommendations in my statement, Mr. Chairman. I look forward to discussing them.
Thank you. Ms. Haddad, you're recognized for 5 minutes.
Thank you. Chairman Lukemeyer, Congressman Scott, and distinguished members of the subcommittee, I am honored by your invitation to testify before you today. De-risking is a phenomenon that has had dramatic impacts on the international financial system over the last decade. De-risking has impacted the concentration of trade flows and cross-border payment activity, which challenges financial stability and inclusion for affected markets. For the United States specifically, a decline in dollar-denominated transactions and flows through U.S. financial institutions has potential implications on commerce, as well as the United States' competitive position. I am the co-founder and chief operating officer of Sigma Ratings, a company we founded to address de-risking by highlighting and incentivizing good corporate behavior globally. Today, my testimony will focus on the drivers and international impacts of de-risking that resulted from the termination of correspondent banking relationships. Since founding Sigma Ratings, my team and I have met with financial institutions and regulators in dozens of countries across Europe, Latin America, the Middle East, and Africa to better understand the challenges of de-risking and determine how our solution can help solve them. We've learned that there are many drivers of de-risking, including profitability and reputational risk concerns, and these drivers may vary from country to country. However, fears of regulatory enforcement actions and fines, as well as the costs associated with complying with anti-money laundering, counter-terrorist financing, and sanctions regulations are consistently highlighted as primary drivers of de-risking. Regulatory fines imposed since 2012 against global banks reached billions of dollars and have had a chilling effect on the robustness of global correspondent relationships. The magnitude of these fines has instilled fear in many global banks and resulted in the reassessment of those banks' risk appetites. Another driver is cost. Global banks are spending billions of dollars a year on compliance, with some banks individually spending over $1 billion themselves. Costs of due diligence and concerns about the compliance regimes of respondent banks are frequently mentioned as the main reasons for termination. While much of bank spending is for critically important tasks, many costly compliance tasks are repetitive and viewed as mere check-the-box exercises by banks. This may distract institutions from the intended outcome of detecting real risk and ultimately identifying illicit activity. As a result of these fears and costs, many institutions determined that the costs and risks associated with maintaining certain relationships are no longer worth the revenue generated, leading to terminations. I'd like to turn to three key consequences of de-risking: financial exclusion, decrease in transparency, and long-term effects. First, research demonstrates that de-risking has direct financial implications for individuals and businesses operating in these markets. In a World Bank report from November 2015, decreases in lending, international wire transfers, cash management services, and check clearing were highlighted among some of the most significant impacts at the local level. Additionally, an IMF report from March of 2017 indicates that small countries with low volumes of transactions experienced increased costs for remittance transfers, which has a direct impact on end users. Second, it has been cautioned by the World Bank, the Financial Action Task Force, and other groups that de-risking may unintentionally drive financial transactions underground or into shadow markets. This makes detecting illicit activity much harder. It is well documented that channels with a low likelihood of detecting illicit activities, such as unregulated industries, are the channels more frequently used by money launderers and terrorist groups for movement of funds. As regulated entities, banks have higher likelihood of detecting illicit activity. Third, de-risking has long-term effects that should not be ignored. We found in our research that many countries and institutions that were de-risked continue to struggle to find new relationships. And for those who do, they're often subject to higher fees and increased due diligence by correspondents, leading to higher costs of doing business. The loss of correspondent banking relationships can also create a long-term stigma. For example, rating agencies have started to consider loss of correspondent banking relationships as a factor for downgrading the rating of a financial institution. With de-risking and its drivers receiving much attention over the last few years, both public and private sector players have presented potential solutions. A sustainable solution, however, will require a change in the overall cost-benefit analysis for correspondents in high-risk markets. Some possible approaches are the following. First, greater sharing of risk information to improve overall transparency and reduce due diligence costs. For a bank with thousands of relationships, due diligence practices, much of which are done manually today, are almost impossible to keep up with. Greater information sharing between both public and private sector improves information availability and transparency. Second, the compliance burden can be further reduced through the use of standardized, independent third-party assessments of potential respondents' risk and compliance practices. An independent assessment would serve as a baseline for a correspondent to enter into a relationship, thus reducing much of the upfront and ongoing diligence processes. Furthermore, standardized assessments would allow for benchmarking across jurisdiction for use by governments as well as financial institutions. This increased visibility and comparability would allow for better allocation of capacity-building resources. Finally, the use of technology to enable financial institutions to better understand their clients and manage their risk should be welcomed. Thank you for taking the time to hold this hearing and for allowing me to share my perspective on this important topic. I look forward to your questions.
Thank you, Ms. Haddad. Mr. Lewis, you're recognized for 5 minutes. Hopefully, it's within a 5-minute time frame.
We'll try.
We have a difficulty with 5 minutes today.
Good afternoon, Chairman Luke Meyer, Ranking Member Clay, and members of the subcommittee. My name is John Lewis, and I'm testifying today on behalf of NAFCU. I'm the Senior Vice President of Corporate Affairs and General Counsel for the United Nations Federal Credit Union. NAFCU and its member credit unions have consistently recognized the importance of BSA and AML requirements in assisting in the prevention of illicit activity. Credit unions are fierce supporters of efforts to combat criminal activity utilizing our financial systems. Credit unions work closely with examiners to ensure consistent application of BSA risk assessments. Still, the implementation of BSA requirements remains a burden for many credit unions, especially in the post-financial crisis regulatory environment. Given credit unions' field of membership limitations, it's important for credit unions to have the potential to serve everyone in their field of membership, whether individuals or legitimate businesses or individuals. Some members may present heightened risks, which can mean increased compliance burdens, costs, and pressures on credit unions. Despite UNFCU's unique field of membership, we have been fortunate to have good relationships with our examiners who have worked with us in riskier areas. However, other credit unions report that, while NCUA doesn't directly prohibit them from serving certain types of members, they feel pressured by examiners to limit services. It is important to note that when a credit union is serving a higher-risk individual or business, they are very thorough in their evaluation and record-keeping. However, when examiners evaluate that relationship, they can be very demanding of the credit union. This additional pressure and scrutiny from examiners can lead institutions to de-risk by limiting services for certain types of members. Sometimes the pressure to de-risk comes not from the regulators, but from law enforcement. Although credit unions recognize the importance of sharing critical information with law enforcement, some report they have received unreasonably broad subpoenas, asking for all information and correspondence related to any members in a certain type of business. The threat of overbroad investigatory demands makes credit unions hesitant to provide services to members that are targeted as higher risk. Credit unions can also be impacted by others making the decision to de-risk. At UNFCU, some of our members have international ties and some are located abroad. As a result, we are presented with a unique set of risks for which we have learned to adapt. We have found that some of UNFCU's longstanding vendors have reevaluated their relationships with UNFCU, even de-risked by ending the relationship due to the fact that we serve some higher risk members. This loss of vendors has led to a significant disruption of services and increased costs to our members. Our unique membership, coupled with our vendor relationships, gives UNFCU a strong understanding of the challenges from both sides of the de-risking issue. Credit unions continue to work with Fincen and other regulators to develop ways to provide services to higher risk members without incurring compliance burdens and costs that are so onerous that de-risking becomes the only option. Some ideas for improvement include, first, creating a safe harbor for the financial institution providing services to high-risk accounts if they meet certain requirements in scrutiny of those accounts. Second, ensuring that risk-based review requirements for financial institutions are understood by examiners. And third, not making the financial institution the de facto regulator of business. While it may make sense for the institution to verify registration and licensing, they should not be forced to verify levels of compliance by the business. NAFCU also supports legislative proposals to address these issues. I outline these in greater detail in my written statement, but they include H.R. 6068, the Counterterrorism and Illicit Finance Act, which takes important steps to update and modernize the BSA-AML regime. H.R. 4545, the Financial Institutions Examination Fairness and Reform Act. Enacting this legislation will provide relief for financial institutions from perceived pressures from examiners. And finally, H.R. 2706, the Financial Institution Customer Protection Act of 2017, that would ensure Operation Choke Point policies will not be used by regulators to prevent the provision of financial services to a member. An additional area where relief is needed is the Bureau's rule on international remittances. The rule has driven a number of credit unions out of the remittance business as the cost of compliance and risks associated with it are too great. We believe that the Bureau should use its exemption authority under Section 1022 of Dodd-Frank to provide relief to credit unions on the issue. In conclusion, NAFCU and its member credit unions recognize the importance of the BSA regime, as well as the importance of regulator and law enforcement scrutiny of riskier businesses. Given UNFC's field of membership, we serve as an example that it can be done. Nonetheless, heavy compliance costs, burdens, and pressures from regulators and law enforcement when dealing with higher risk members and businesses can lead many to de-risk and stop providing services to them. Congress can help by working with financial regulators and law enforcement to alleviate these burdens and pressures. NAFCU stands ready to work with you in this regard. Thank you for the opportunity to appear for you today. I welcome any questions you may have.
Thank you, Mr. Lewis. Ms. Yearwood, you're recognized for 5 minutes.
Chairman Lukemeyer, Ranking Member Clay, and members of the subcommittee, thank you for the opportunity to appear before you today. As one of the most insidious threats to the Caribbean's economic sustainability, de-risking is destabilizing economies, threatening trade, and creating security concerns, and it requires constructive solutions. I would like to begin with some examples. In 2015, on instruction from their U.S. correspondent banks, the two banks in the Cayman Islands that supported money transfer businesses severed those relationships, and the MTBs, which provide critical remittance services, were forced to shut down. This led to moving cash in planes in order to make sure that the affected population had access to finance. Today, only one MTB remains open. Tourism is one of the Caribbean's most important industries and generates significant demand for U.S. goods and services. About 4 years ago, a leading hotelier told me that they had received a letter from their longtime U.S. bank. It essentially said, "As of today, we are no longer your bank." There was no valid explanation and no opportunity to address concerns. I spoke to that hotelier last week in preparation for this hearing to see how they had resolved the issue and was told that finding a new U.S. bank was extremely difficult and that they still feel that the situation is precarious. They did not want me to use their name, the hotel name, the name of the US bank that they are now using, or disclose the country or countries where they operate. This last point underscores why getting a grip on the impact of de-risking can be so difficult. A legitimate business that has lost its US banking relationships, regardless of whether or not there is any real risk present, has the stain of de-risking on them. So they keep it quiet and try to replace a lost relationship. Bottom line, it's like Fight Club. The first rule of being de-risked is you do not talk about being de-risked. The toll has been highest on small and medium-sized business, where the costs of banking are becoming prohibitive. We have seen a rise in cash and informal economies in some jurisdictions and the operation of parallel foreign exchange markets. Even for long-established businesses, banking has become burdensome. One US company that operates in the Caribbean reports that a basic process like opening a new account that used to take 10 days or so now can take up to 60 days and require 10 times more paperwork. The Caribbean Association of Banks reports that 9 members have no US correspondent banks but have been onboarded by third parties to manage these banking services, and 17 members have only 1 US correspondent. At the same time, they report a 39% year-on-year increase in correspondent banking fees between 2014 and 2017, and the costs of compliance have increased approximately 66%. As relationships are lost with US banks, they are being sought in Asia and the Middle East, and if the United States doesn't work to address the challenges, countries may have no option but to build new relationships and prioritize trade with other countries. While de-risking is motivation for the loss of banking relationships, the reality is that profitability plays a significant role as well. These are small economies in a global system, and weighing perceived risk with profitability does not always work in the Caribbean's favor, even though the region has been working diligently to improve its profile. It is important to stress that no one is advocating for a removal of the rules. Today's world requires that we build systems that have the capacity to recognize and eliminate threats, but this should not be done in a way that forces legitimate actors out of the system. And there are a number of ways to change the narrative. First, the U.S. Department of Treasury provides important assistance to the region. Resources could be made available to allow the department to deepen its engagement there. Another idea related to Treasury is that if larger banks are not going into the market because of the profit ratio, is there a scenario wherein community and minority banks are encouraged to serve the Caribbean using the platforms within large banks, with the large banks who make their platforms available receiving credit under the Community Reinvestment Act? Second, innovation has the capacity to level the playing field. This is happening in the Caribbean, where we have seen the emergence of technology companies that are working to remove financial friction points across the region. I also believe that some consideration should be given to the issue of proportionality. Fines can reach billions of dollars. Taken in context, Belize, which has been particularly affected by de-risking, had a GDP of just under $1.8 billion in 2016, along with $1.3 billion of external debt. If the application of the rules is weighted against small economies and their inherent vulnerabilities, how do we keep them viable? In conclusion, taken as a group, the countries of the Caribbean and Central America are the 5th largest buyer of United States non-oil exports, and the U.S. consistently records a trade surplus. If access to banking is removed or becomes more costly and difficult, it is likely that this healthy relationship will begin to be eroded. Second, the countries of the Caribbean and Central America are the United States' third border. When the countries of the region experience instability, mass migration is one risk, and the absence of the U.S. actively working to help the region, the door is open to other parties who may be antithetical to the United States' security interests. CCA is grateful to that this subcommittee has provided this platform. Thank you, Mr. Chairman, for the opportunity.
Thank you, Ms. Yearwood. Appreciate everybody's comments. And with that, we'll begin the question part of our discussion today, and I'll begin with my questions. Mr. Clements, you and all the witnesses today have described concerns about the problems of de-risking across the board with regards to how law enforcement and regulatory officials have come down on people in the financial services industry. Is law enforcement aware that they are deterring actual profitable, well-intentioned business? And if they are, do they have some ideas on how to fix the problem so they don't deter normal activity? Or are they content with driving everybody out of the business altogether?
I would say in the two reports that we looked at here, we were not talking to law enforcement, so I can't speak to the effect of whether law enforcement's aware of it. I think you bring up a relevant issue is in many instances it's not people instructing banks, for example, to drop a customer. It's simply the effect of working through the examiners of saying this is a high-risk customer. Next thing you know, it involves additional staff and additional resources. There's the risk to large fines that we've heard about, and those things create an incentive for the bank to essentially drop service rather than have to deal with that potential risk.
Well, it's very concerning because it's a manifestation, a morphing, if you will, of Operation Choke Point into other areas here from the standpoint of trying to intimidate the banks and discontinuing financial services with customers who are legitimate customers who are doing a good job. Mr. Clements, I believe you were the one that indicated and had some nice charts in your testimony that showed the counties along the border between the United States and Mexico are being dramatically impacted where they're closing branches so they can't do any business, so they can de-risk themselves of their problem. I guess my question is, have you seen that next county above them? Are they starting to de-risk as well? Are they starting to close financial services? Because I would assume that if you close the branch off next to the border, that people start going to the next county over. Is that happening as well or starting to happen now?
Our experience was just with the counties on the southwest border. It was certainly the case that one option that consumers have if they lose their branch in that community is to go one community over and have to travel to that branch. The other options they have essentially are mobile.
Mr. Lewis, your credit unions, did you see that happening? You see them closing on the border and then moving to the next county over to where you're starting to get some pressure to be able to close those next?
We UNFC are not seeing that as we're not located on a border state. We know that there are credit unions that are under pressure and have had some issues with it. Certainly, I could get back to you and provide a written response to that in more detail if you like.
Thank you. I've got another question here with regards to, there was an article from Reuters back May 8th, 2017. The headline is Chinese bank payment networks surge as Western lenders cut ties. And there's a study to show this, and I quoted the numbers in my opening statement here. And the last part of this says the U.S. dollar dominates world trade, but there's a trend towards a decline in the use of U.S. dollar and an increase in the use of the renminbi, which is the Chinese dollar, if you will. Have you seen this going on, any of you, where we've seen that there's a risk to the U.S. dollar being the reserve currency, to where we're starting to trade in other currencies versus the dollar? Mr. Clements, did you see any evidence of that?
We have no evidence of that.
I should say we know that you deal with a lot of charities around the world, and it's terrible that even they are being hurt by this. I mean, who wants to launder money through a charity? But that's the ultimate slap of whatever. Can you comment on this?
On the question of reversion to alternative currencies, we did not see that. But I would say that in terms of the first point that you raised on law enforcement, I think it's a very interesting comment because law enforcement actually has been extremely concerned about the loss of traceability and transparency, that as these NPOs are de-risked, they will either use cash, they will use MSBs, they will use alternative means.
Ms. Dowd, I'd like for you to comment, and Ms. Yearwood as well, on this question. Have you seen any problems with this, concerns?
I haven't seen it directly, but I have heard from people, particularly in Africa, from banks there, that when those banks were de-risked, that some Chinese banks picked up the correspondent relationships that were previously held by U.S. correspondents.
Yeah, their relationships are picking them up left and right, like leaves on the ground here. Ms. Yearwood, have you seen anything like that with the Caribbean banks that you're dealing with?
I don't have any evidence of Caribbean banks getting Chinese accounts. However, what I have been told is that some Caribbean banks have tried to get Chinese accounts, but not been able to get them because of the ongoing relationship to the U.S. dollar.
Okay, thank you very much. My time is up. With that, we go to the ranking member, Mr. Clay.
Thank you so
Recognized
much,
for 5 minutes.
Mr. Chairman, and thank the panel of witnesses for being here. Let me start with Ms. Yearwood or Ms. Eckert, or both of you. What would give financial institutions more comfort in serving remittance service providers, especially those serving fragile nations? Can you help us with that? Whoever wants to go, Ms. Yearwood.
Thank you, Ranking Member Clay. I think in my testimony, I point to some of the things in terms of the assistance from the Treasury Department that could help give a certain amount of comfort to the people who are providing services in the region. That being said, the remittance side of the coin, I'd actually like to, I actually think Gabrielle Haddad may have some input, because I think transparency and the ability to have traceability of where the money is going and coming from is key, especially when you're moving very small amounts of money. So
Right.
I'll defer to Ms. Eckert, and then Gabrielle may have something to
Go
add.
right ahead.
Thank you, Mr. Clay. I think that what banks are asking for in this particular area as they relate to NPOs is they're asking for some clarity about regulatory expectations, what is expected of them. And in fact, to the point of the interviews that I conducted, I had banks who say that they can manage risk. That's what their business is. However, what they can't deal with is regulator risk, and that is examiners second guessing them all the time in terms of what their assessments are under a risk-based approach. The other thing the financial institutions want is they want more information to be able to make the best informed decision. So part of the process that we're engaged in is identifying what information financial institutions need from NPOs and getting NPOs comfortable providing that to banks so they can break down some of these perceptions that exist about each other.
Thank you. Ms. Haddad, anything to add?
I would just add that I agree that the information sharing is a huge challenge that banks face, both from money service businesses and from respondent banks, in order for them to actually obtain the information that they need to make assessments of their relationships is incredibly challenging. And this is resulting in huge burdens and a really lack of clarity, as Ms. Eckert mentioned, around what their regulatory expectations.
So it is more of the uncertainty on the part of banks that they are hesitant to go forward.
That's what it appears to be. Yes.
I see. For this question for Mr. Clemens and Ms. Eckert, what specific steps do you believe Congress or state governments can take to address the adverse consequences of de-risking remittance service providers?
We have a variety of recommendations out to the federal agencies in terms of Treasury and the banking regulators to conduct retrospective reviews, actually looking at this issue of de-risking. The last round, they simply looked at the currency transaction reports in the SAR filings, but didn't get into this underlying cause of what is causing a bank to de-risk. The second thing we've asked Treasury to look at is this issue of de-risking in these remittances and the movement then of funds out of the banking system to non-banking channels. How does that affect Treasury's ability to actually monitor criminal activity? And those are a couple of things we've looked at. We've also recommended in the past in terms of efforts among the bank regulators to sort of reduce the burdens associated with these activities.
I see. Ms. Eckert, anything to ask?
Yes, I think first and foremost, again, is some clarity from the regulators about what's expected. And here, in particular, the Bank Examination Manual, the standard changed for NPOs in June of 2016, yet there is nothing reflected other than statements by officials, which are helpful, but the bank has nothing to rely on in terms of how they assess risk associated with NPOs. Currently, it's an outdated assessment, but banks have nothing to hold on to, if you will, and to help them make the appropriate risk assessment. The clarity, the regulatory guidance. I think another thing is to recognize the importance of humanitarian assistance, emphasizing that humanitarian assistance, humanitarian development assistance are important U.S. objectives. They are important for foreign policy. They're important for countering violent extremism and promoting the kind of values in certain of these higher risk areas to rely on U.S. support. And the other is to consider incentives. What can we do that will actually encourage banks to take the additional step to bank NPOs?
And I see the chairman won't let me go over my 5 minutes, so I yield back. Thank you for your response.
The gentleman yields back, In fact, he went over 5 minutes significantly, but that's okay. We're not counting today, are we? With that, we go to the Vice Chairman of the committee, Mr. Rothfuss from Pennsylvania. He's recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Yearwood, as you know, many poor and unstable countries rely heavily on the flow of remittances from the United States. Haiti, for instance, received $1.3 billion in remittances in 2015, and its GDP is only about $8 billion. What are the potential impacts of a loss of remittances due to regulatory pressures on U.S. institutions for countries like Haiti, Somalia, and Nepal?
I think it's impossible to overstate how important remittances are to Haiti. I don't have the precise numbers on me, but it is a significant portion of their GDP that is through remittances. Going back to one of the statements earlier, what you will begin to see is not just a drop in remittances, but an increase in money moving through unofficial channels, money that cannot be regulated. So it puts pressure on the system, it puts pressure on kind of securing the network, and of course it has the impact on, will the money get to the people that it's supposed to get to? Will the money be diverted on the way, and will it get to people that it's definitely not supposed to get to? So I spent 10 years in Haiti, and so I know firsthand that remittances are a significant part of what drives the economy at this point. If it were to go away, I think there would have to be serious consideration about how the U.S. engage Haiti in other ways to improve trade and other kind of parts of the things that aren't necessarily subject to this hearing. But the remittance channels right now need to be kept open and alive. And I should add that Haiti's banking system very much under stress because of this issue. I believe they have maybe one, maybe two U.S. correspondent banks right now. And so if it remains fragile, it could go south.
With respect to the risks of going to unofficial channels and maybe remittances not being made at all, would among the risks there be any security or political stability risks?
Oh, absolutely.
In what sense?
Again, if remittances make up such a large portion of the GDP, I wish I'd brought the number, but I will get that to you. They make up such a significant portion of the GDP. We are talking about a country that has high unemployment, low education. If people aren't able to pay for school fees, for school books, for health, for food, political stability is absolutely threatened, and of course that has implications, as we saw back in the 90s, on migration.
And in 2015, there was a paper from Oxfam. The Oxfam Global Center for Cooperative Security suggested that de-risking practices will likely result in the further isolation of vulnerable communities, particularly women, from the financial sector, and may have wide-ranging humanitarian, economic, and security implications. Would you agree with that assertion?
100%.
Let's see. There we go. Ms. Haddad, the GAO found that several money transmitters, including all of the Somali money transmitters, reported that they were using non-banking channels to transfer funds. In some cases, the money transmitter was forced to conduct operations in cash. What are some of the risks associated with pushing remittance activity out of the formal channels?
I would say that there are a number of risks with that happening, because as it goes outside of the channels, you can't monitor it anymore. You don't know where the money's flowing. You don't know who's transacting business.
Well, do you believe that the regulators would have appropriately weighed the risks of this activity leaving regulated markets?
Do I believe that they have?
Would you believe that the regulators have weighed those risks of pushing remittances out of activity?
I'm not sure if I believe that this is, a lot of this is, there are unintended consequences of these regulations. I don't think that it was intentional or even.
Are they
something
considering that? Would they be considering that, do you think?
I don't know. I would hope so. I don't know.
Mr. Lewis, in your testimony, you expressed support for facilitating BSA AML innovation by financial institutions. How can emerging technologies help to address the problems caused by indiscriminate de-risking?
Well, thank you for the question. Certainly technology helps because much of it's about monitoring and crunching the numbers on the accounts. It's tying certain transactions to other transactions, accumulating those transactions together. So I do believe technology will help and has helped and will continue to with BSA. The one thing with technology is we want to make sure that all the technology and all the fintech companies are regulated equally, and that it's a clean playing field, if you will.
Yield back.
Gentleman, time has expired. With that, we go to the distinguished gentleman from Georgia. Mr. Scott's recognized for 5 minutes.
Thank you very much, Chairman Lukemeyer, for holding this hearing. And I also want to thank you, Chairman Lukemeyer, for your leadership on the Operation Choke Point legislation, H.R. 2706, which we passed out the committee, got through the House. But I want to remind everyone that it was Mr. Lukemeyer and I who were working on this bill when it wasn't generating as much support, and it wasn't a popular thing to talk about back then, especially for some of my Democratic friends. But we have grown with this legislation. It has passed. It's over in the Senate now, and we hope that we can get it through. But our bill gets at the fundamental purpose of what we are discussing today, and that is there are real side effects that have a real impact on our economy when the regulatory pressure we apply on our financial system is too strong. And our choke point legislation would prevent federal banking agencies from ordering a bank to terminate a customer's account without a material reason. And that reason could not be based solely on reputation risk. Now, Ms. Haddad, how are you? In your testimony, you provided an interesting recommendation for a way forward on how to deal with the de-risking trend we've seen lately. And your recommendation caught my attention. And it was, I quote, you say, use of technology to lower AML, CFT compliant costs without the fear of regulatory backlash. That is at the core of why we are here. And I am the co-chair of the FinTech Caucus here in the House, and I share your enthusiasm about using innovative technologies to solve many of the problems we have in today's financial system. And you say in your testimony that we should establish channels for regulatory approval and support of innovation. Tell me, are you envisioning a sort of sandbox approach to regulation?
Thank you for your question. I think that a sandbox approach is a very good one. I think that it's one that could be beneficial. We are a young fintech company ourselves, and we are in regular conversation with regulators because that's something that we've sought out on our own. But getting that type of engagement is quite challenging, and particularly working with banks and having them become comfortable trying out your technology and being able to see how it benefits their business is a real challenge without some sort of safeguard in place from regulators.
And as you know, and I'm sure as the committee knows, there has to be a delicate balance between allowing innovation while also, at the same time, making sure our regulators stand firm on compliance and enforcement. And so, Mr. Lewis, I'd be interested to hear how you feel about the approach and recommendation that Ms. Haddad is offering.
Thank you. I appreciate it. I think that any way technology can benefit, we should be looking at it. One of the problems we run into with technology and new technology is that technology is expensive. It's very resource intensive. Our systems at our credit union, many credit unions, are extremely complex. Creating the interfaces between the systems and the new technology, testing the new technology, demonstrating that to regulators can be expensive and resource intensive. So we certainly are always willing to and very interested in looking at new technologies. We use technologies to operate our credit union on a daily basis. Some is homegrown and some is bought from vendors. But it's not so easy always just to test out a technology because of the entry costs for us.
And tell me about that cost. You say it's very expensive, but give us an idea. Give us what you're talking about. Why do you say that?
Well, I can give you one example on the remittance side. When the remittance regulation came into effect, there was requirements for disclosures. And we had to use outside third party in order to create these remittances, to originate the remittances, because we weren't able to do it ourselves. In order for us to create that interface with this outside third party, UNFCU spent over $1 million to create that single interface with this outside entity, and it took about 3 months of time.
Well, thank you. Ms. Haddock, you concur with that?
Costs of engineering costs of developing technology is incredibly high, and banks are trying to do this internally, and they're incurring a lot of costs internally. As an external company that's trying to work with banks, I understand the costs. The costs are significant, and it's helpful to be able to work with third-party companies to reduce the costs that the banks themselves have to face in leveraging these technologies.
Well, thank you both. Thank you, Mr. Chairman.
The gentleman's time has expired. I, too, want to thank Mr. Scott, though, for his leadership and tenacity in working with us on Operation Choke Point. We were kind of like the lone voices in the wilderness for a long time, weren't we? And now we can see the effects, even at the international level, of some of these policies and actions that were taken. So I thank him again. With that, we go to the gentleman from Colorado. Distinguished gentleman, Mr. Tipton, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank the panel for taking the time to be here. Mr. Lewis, if I could maybe start with you. We'd had comment from Ms. Sherwood, I think, saying that some of the compliance costs had gone up 66%. You just cited $1 billion of investment that had to be made. Some of that seems to be coupled back with what Ms. Eckert was talking about when she'd made the comment that banks have nothing to hold on to in terms of having some real guidance. Does that feed on itself not having some certainty in terms of what you're going to have to be dealing with, in terms of de-risking, what you need to be looking for? I found it a little concerning when you're citing that you'll have some of the law enforcement agencies that will come in and ask for a broad swath rather than an individual account that they would like to be able to look into, which speaks to the chairman and Mr. Scott's words in regards to Operation Choke Point. So are those issues, when we meld them together, is that creating real complexity for you? And you'd cited a few bills in your testimony that we're working on out of this committee. Would you maybe expand on how those might be helpful as well?
Well, first, thank you very much for the question. I would say that yes, those things in combination provide complexity for us. They comply its cost, its resources, and it is the uncertainty. In essence, we're talking about risk here, and risk is uncertainty. And for an institution like ourselves, if we have some certainty, then we're able to evaluate the risk and mitigate against that risk. It's the uncertainty that causes the problems with us and in our industry. So anything that the regulators, Congress, the Bureau can provide some certainty on is beneficial. I think some of the bills that we were talking about here, certainly, relief on 6068, which is the BSA-AML bill, that will certainly help us, maybe not with uncertainty, but it will reduce some of the burdens as some of the caps will be raised on what we would need to report. 4545, Financial Institutions Examination Fairness. Again, this would provide institutions with the ability to challenge or to go to the next level if they have problems with the regulator or examiner. So I think, and certainly Operation Choke Point would help, because theoretically that would reduce the regulatory burden on credit unions and financial institutions.
Great, thank you for that. And you might want to speak to this as well, but I'd like to be able to talk to Mr. Clements a little bit in regards to some of your testimony. I happen to live in an area, southwest Colorado. We have a lot of high-intensity drug trafficking designation areas, 5 counties, southwest Colorado. Are these areas more prone probably to be suspect for de-risking by banks as we move off of the borders that you'd noted in some of your charts and start to move up in states as far north as Colorado?
We conducted an econometric model as part of our report, and in that case, it was nationwide, so we weren't just limited to the southwest border states. So to your point, some of the variables we did look at was the high-intensity drug trafficking area, high-intensity financial crimes areas. In both those types of locations, if the county was designated that, it had a greater likelihood of losing a branch the following year. So those are certainly factors in the declining number of branches in communities, not just along the southwest border, but nationwide.
Great. Do you have some examples of some misplaced assumptions of high risk because of the height of designation for some businesses?
We looked at a variety of classes of customers that stakeholders have told us were sort of at greater risk of money laundering. Those would be cash-intensive small businesses, money services business, and also domestic businesses that have a lot of cross-border transactions. Those would be the ones that we told us would be related to money laundering, not exactly that particular business. You could have a business that's completely legitimate operating in that space, but money launderers, their transactions tend to mirror the type of transactions that you would see businesses in those spaces engaged in.
And so probably the extension would be natural, and Mr. Lewis, you might want to speak to some of this as well. Do the banks de-risk because maybe of that height of designation, simply for the fear that they're going to be out of compliance and have a challenge with that?
Well, certainly, we haven't experienced that directly, but I know many of our credit unions have. And what it comes down to is it comes down to the intensity of scrutiny, both from the regulator and law enforcement. So it may not be a directive to de-risk, but in essence, it's an indirect effect of the intense scrutiny, either by a regulator and or by law enforcement with regards to these businesses.
Great. Thank you. My time's expired, Mr. Chairman. I yield back.
The gentleman's time has expired. With that, we go to the gentleman from Georgia, Mr. Loudermilk, recognized for 5 minutes.
Well, thank you, Mr. Chairman, and thank everyone on the panel for being here. Ms. Haddad, in your testimony, you talked about how de-risking reduces transparency by redirecting money to unregulated channels. Can you elaborate a little bit on how that happens?
Sure. I'd like to highlight something that happened actually just last month with a bank in Argentina. This bank chose to drop SWIFT in favor of a strategic partnership with BitX, which is an unregulated crypto exchange firm. And they're now using this crypto exchange firm to settle their international payments. And the CEO noted for the reason cost, and said that having an intermediary was an example of what the cost of having an intermediary was too high. And I bring up that example because we speak a lot about other unregulated industries like Hawala and unregulated money service businesses, as well as movement of large amounts of cash cross-border, which are things that happen. But I wanted to highlight that because I think that this is critical in today, with the change in the payment landscape, with the rise of crypto exchanges, with the rise of alternative payments, that this is what's happening now, that these alternative providers are now gaining traction, and banks are no longer a part of the system.
So I know that we've been dealing a lot with the cryptocurrencies here in the U.S. with the blockchain technology, which I think when you divest the cryptocurrency from blockchain's an interesting technology, but it also it gives some challenges to law enforcement. So what you're saying is because of this, the de-risking, we're forcing some businesses into these somewhat underground networks and make it harder for us to track and trace.
Exactly. There's no alternatives for the payments to flow or for money to flow if they can't access either a remittance firm, a regulated remittance firm, or a bank. And that is why we're seeing the rise of, or one of the possible reasons why we're seeing the rise of these alternative systems.
So we're really being counterproductive through this de-risking, is creating more risk.
It's possible. It is possible. I believe that there actually have been some studies that have shown that when the de-risking has occurred, that money laundering has increased. I don't have those exact numbers. I could get them for you, but there have been some instances that I've read in the past where there are, that has happened.
Okay, thank you. That was a very interesting anecdote. Mr. Lewis, I want to talk a little bit about the suspicious activity reports. Can those contribute to the problem of de-risking? Because the SARs are such a compliance burden, especially on smaller institutions.
Yes, thank you for the question. Certainly, SARs, BSA, AML requirements create a lot of constraints for smaller financial institutions and even for institutions like ourselves. People talk about the volume of SARs, which is certainly something that we need to look at, but also we have to understand is that behind each SAR, there's a tremendous amount of research and investigation and decisioning that goes into it. We take SAR filing very seriously, and while we're told by the regulators, don't file too many SARs, we don't want defensive SARs, we're also told by the regulators, make sure you file the right SARs. And so for us to strike that balance at any institution, it takes a lot of research, a lot of investigation to do it. We certainly support 6068 by raising the limit of the SARs, modernizing BSA, because that in and of itself would eliminate the need to file at least some SARs, which would provide some relief for us and certainly for some smaller financial institutions.
Well, besides raising that limit for the SARs, is there anything else that you would recommend that we could do to reduce that burden?
Well, certainly more guidance and certainty would help out as well. Where a lot of the consternation we have is, should we file the SAR, shouldn't we file the SAR, under what circumstance should we, under what circumstances we couldn't. Now, we do receive some guidance from the regulators, but even more guidance, or maybe some possible safe harbor, don't know how that would work as I sit here, but something that would give us an opportunity for more certainty with what we're doing.
Okay, well, thank you. Mr. Chairman, I yield back.
Gentleman yields back. With that, we go to the gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Mr. Chairman. Risk management is one of the most important functions that a financial institution performs. As a business owner myself, I can relate to the effect that compliance challenges, especially the excessive growth of federal regulations over the past 10 years, it's been hard. De-risking forces an institution to perform the cost-benefit analysis of doing business with a customer. Operation Choke Point is one of those many examples of executive overreach from the previous administration. While this administration has taken deliberate action to curb efforts like Operation Choke Point, we must be vigilant for future occurrences. And this isn't theoretical, it's reality. I know firsthand how this occurs because I have experienced Operation Choke Point. Now, while I understand the importance of risk management, it is important not to view whole industries as potentially high-risk groups. Applying a single standard to industries in different states with different business owners and values is inconsistent in my belief. So, Mr. Lewis, first question. How would you categorize the working relationship between state banking supervisors, federal regulators, and industry stakeholders when it comes to discussion of de-risking?
Thank you for the question. From our experience, I think that there is some unevenness that goes on. We are a federally chartered credit union, so we don't have much direct contact with the state regulators. So NCUA is our examiner and regulator. We do, however, through law enforcement, we will receive subpoenas and we'll receive others, and a lot of times there's not coordination between those various areas of law enforcement with regards to the subpoenas.
Okay. Next question also, Mr. Lewis. I introduced H.R. 3626, the Bank Service Company Exemption Act. This bill would enhance state and federal regulators' ability to coordinate examinations and share information on banks' technology vendors in an effective and efficient manner. So my question would be, can you touch on the benefits to authorizing state regulators to examine third-party TSPs and how that could avoid duplicative examinations and reduce regulatory burden on an institution?
Yes. Again, thank you for the question. We're a federally chartered credit union. I personally don't have a lot of experience with state credit unions or regulators. What I can say is we would welcome the opportunity to follow up with you in writing with that question so we can provide a good and thorough answer.
Okay, thanks. Mr. Clemens, the Justice Department recently announced the end of Operation Choke Point. Are you aware of any account termination notices since that announcement?
Not aware of any. We haven't conducted work since that point.
Okay, thank you. I might ask if anybody else, the question I talked to Mr. Lewis, again repeat if anybody wants to answer this. Can you touch on the benefits to authorizing state regulators to examine third-party TSPs and how that could avoid duplicative examinations and reduce regulatory burden on an institution. Would anybody like to answer that? Yes, ma'am.
Congressman, I would just note that the question of state regulators has become an important issue because there are growing fines. For example, the New York Department of Financial Services have had significant fines on numerous banks. And I think that because they are looking at it from a different perspective, it has become a very significant issue, incompatibility perhaps of how some of the regulators are actually looking at it. The other question is examiners. And the disconnect, either at the state level, but in particular at the federal level, the disconnect between what policy is and what's going on at the examination level. The examiners are sitting with the banks day in and day out. I had a situation where one financial institution said, their examiner asked them, do you know your customer's customer? And when the bank said, well, according to the 2006 guidance, we don't need to know our customer's customer, the examiner didn't even know that there was August 2016 guidance. So I think that there's an important, compounding effect of state regulations on top of the federal ones.
Okay, thank you. In my remaining time, I might ask all of you, getting back to Operation Choke Point, does any of you know that if account termination notices have been sent out or anything, or how that's going to happen? Choke Point? Okay, very good. I yield the rest of my time back, Mr. Chairman.
The gentleman's time is yielded back. With that, we go to the gentleman from Tennessee. Mr. Kustoff is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank the witnesses for appearing this afternoon. Mr. Lewis, if I could go a little bit broad and talk about going back to the 2008 financial crisis and the enactment of Dodd-Frank. We've seen financial service regulators expand their powers significantly. I think we can all agree to that. With the heightened regulatory requirements coupled with the prospect of financial entities receiving fines for potential violations, we've seen a significant decrease of products that many community banks and credit unions now offer. I think a lot of times you see consumers look elsewhere to find where they can have their services met, their needs met. Some leave the financial system entirely. If I could, 2 questions. One is, can you discuss the consequences to driving those customers out of the financial system? That's the first question. And then the second question is, or towards that end, where do those people typically go when they no longer have access to the financial products that a credit union or a community bank would offer?
Well, thank you very much for the question. I would like to add that in addition to my role with UNFCU and with NAFCU, I also recently was the vice chairman of a community development credit union in New York with less than $1 million in assets. So I have experience in both the large side and the small side. And with that community development credit union, unbanked and underbanked is a major problem in the community. For various reasons. So if these folks leave the standard banking channels, they lose the opportunity for credit, they lose the opportunity for credit reporting, they end up in areas where could be check cashers or places where they're paying a huge amount of fees in order for them to be able to cash their checks. They don't have access to standard insurance products. So anytime anyone's pushed out of the traditional banking industry, they're generally not going to a better place. Certainly we know that from the credit union perspective. I mean, credit unions as financial cooperatives owned by the members, the reason of being is to serve the members. So we're always looking to serve those in our field of membership, and we'll continue to do so. But we think that anyone who leaves the system is not going to a better place.
Thank you very much for your answer. Mr. Clements, if I could, we've talked about the problems along the southwest border. And in February of this year, a report was issued by the GAO that examined de-risking along the southwest border. The 3 factors I think you've identified that are unique to account closings at financial institutions in the region. Specifically, I think you noted that these accounts are generally cash heavy. They involve foreign account holders, and those transactions cross or transcend country boundaries. Can you explain why these findings are unique to the southwest border? And what are the characteristics that have been important drivers, if you will, behind the branch closures in the region?
So correct, those were the factors we had cited, right? If one large number of cash transactions. Just to give you an indication there, the currency transactions reports, 30% more currency transaction reports filed by banks in the southwest border region than sort of comparable counties, which has the issue of a lot of lack of transparency if you have a lot of cash transactions. Then also the issue of the cross-border transactions. The concern there is that a transaction crossing the border can look very much like money laundering, even if it's a completely legitimate transaction. We spoke with a farmer in Nogales in Arizona, and she had operations in Arizona and Mexico, and she needed to move wired monies from her Mexican operation up to the U.S. bank, and after a while the bank told her, this is too much risk for us to having these operations going back and forth. And then again, lastly, the issue of the foreign account holders, and just a problem with being able to identify that customer and to meet the customer identification program requirements under BSA AML.
Thank you very much, and I yield back the balance of my time.
Gentleman yields back. With that, we go to the gentlelady from New York. Ms. Tenney is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to the panel for appearing today. I really appreciate you being here. And obviously, de-risking has become somewhat notorious, especially in a community like mine. But under the Obama administration, Operation Choke Point attempted to cut off financing for ammunition and gun manufacturers like Remington Arms, which was founded in my district over 200 years ago, and a new industry, a new competitor in that market called Oriskany Arms. And so we know we've experienced some of that in our own area. But I'd like to look at a couple other things, angles at de-risking and the links to the closure of a lot of branches, small businesses, or small banks and community banks, and also credit unions in my region, which really dominate where I live in my district, and the implication on our very large immigrant and refugee populations. Many of these people would like to send their money back to their home countries and do it in a safe way, but under de-risking, of course, they've been pulled from a reliable and a safe way to send that money over. One of the issues is by pulling that out, and there was a study, and the Government Accountability Office came up with some numbers that the banks are now just terminating those accounts, and they're not able to do that, so they're forced to go into other means. I was wondering if you could comment, and I've just kind of asked everyone across the board generally on what is being done or what we can do on our side to try to deal with this de-risking phenomenon and how we help people who are in that situation. And maybe we could just go right through from Mr. Clements on down. And I want to just save 1 minute left because I have a question for Ms. Eckert at the end having to do with New York State.
We have a variety of recommendations to the agencies to address de-risking on Fincen and the banking regulators, again, conducting retrospective reviews to really get at what's the underlying causes of de-risking rather than simply focusing on more superficial level of concerns. And then second, getting to your point of the remittances, we've asked Treasury to look at de-risking is causing banks to cancel these accounts. Therefore, the remitters have to move to non-banking channels. What is the implication of that for security? What is the implication for consumers being able to get the types of services they need?
So that, and as we go down the line, let me just also add that I'm in an area where we don't have as much connectivity in terms of broadband, in terms of being able to get on the internet. And we have a lot of our refugee population and a lot of our seniors don't have access either. So maybe you could just kind of address that while we're saying how do we provide this service back to a bank where they're not going to be subjected to, in this case, obviously from New York, excessive regulation coming on the New York side.
The concern with if a bank branch closes, that obviously limits the number of options for the consumer. I was going to say one of the options would be mobile banking or online banking, but if that's not an option, then,
not always,
then the person is either forced to find another bank if there is one in that area, or start driving 45 minutes to an hour one way to get to another institution.
Thank you, Ms. Eckert. And if while you're at it, we got to quickly just comment on the New York State regulatory regime in this space, if you could, please. You alluded to it earlier, so got my interest on that.
I think it's important, so what happens when these communities are de-risked? In the case of nonprofits and charities, their mission is to provide humanitarian development assistance. So they don't really have the option of saying, well, we're not going to do it. In only, I think, 3% of the cases, what we surveyed, did they cancel the program. What they have done is to find the other alternatives around, which is carrying cash. It's using unregulated money remitters. It's, and all of those things come at a cost. For charities in particular working in conflict zones, those come at a personal cost in terms of safety. Carrying large bags of cash is enormously, inherently dangerous for their staff and for their beneficiaries. But more than that, it drives these things underground, which means that they are not traceable and that they're not transparent to regulators. The charities prefer to use the banking system. In fact, some of them aren't even comfortable with money service businesses as much, but there's no alternative.
Do you find that the New York State government has been effectively making it more difficult for a lot of these people to have access, or a lot of the charities that you're referring to, not-for-profits, having access to a way to be able to avoid having to carry around cash and to be putting themselves at risk? I'm running out of time.
I don't have direct information with regard to the New York system, but what I will tell you is that the personal liability, now that individual compliance officers, those things all contribute to what financial institutions have to decide, which is it's just not cost effective for us to bank these charities.
Thank you. I'm sorry. Thank you very much to the panel. I'm out of time. Thank you.
Gentlelady's time has expired. With that, we go to the gentleman from Kentucky, Mr. Barr, who is chairman of our Monetary Policy Committee.
Thank you, Mr. Chairman. Thanks for holding this important hearing, and wanted to start with Mr. Lewis and touch on some testimony that you offered earlier about the need to modernize SARS and these suspicious activity reports under the Bank Secrecy Act and your call for a greater guidance and certainty from the regulators, maybe a safe harbor. What percentage of SARS would you say, if you have an estimate, would actually justify further scrutiny or investigation by regulators or officials investigating genuine cases of terror financing or money laundering?
I would say on the terrorist financing side, very, very, very small percentage. On the money laundering side, I mean, I couldn't quote a percentage. I would say that there's some, but many of the SARs that we file, while I think they are legitimate SARs under the guidance, are probably not indicative of any sort of illegal activity. Remember, SARs is suspicious activity. It's not necessarily an illegal activity.
Right. And that's the difficult balance that we have to, as policymakers, we have to figure out how to strike that balance. If we were to create a safe harbor, if the regulators were to create a safe harbor, how would we know we're not missing something?
Well, I think that's always the balance. I mean, we're never going to be sure we're not missing something, but there's going to be a balance of the effort and what the utility of it is. As I said, I couldn't sit here today and chart that out for us, but certainly I think it's worthy of a robust discussion. We would welcome the opportunity to discuss that further.
Thanks, and I'll move on, but I would invite further feedback from any of the witnesses about what a safe harbor would look like, so as to ease the compliance burdens while at the same time not missing any critical information for law enforcement. Ms. Haddad, from your testimony, it sounds like you believe there is obviously a complicated set of factors that have led global banks to de-risk and stop offering some or all services in a particular region due to non-credit risk. In your mind, what is the number one reason why these banks are de-risking? Or if there's more than one factor, you can offer that as well.
I do think that it's difficult to pinpoint the number one because they're all interrelated. So profitability, for instance, profitability concerns is related to increased costs of compliance. And so all of the factors end up being related to one another. But I do think that that one of the biggest challenges is around balancing the cost of compliance with the revenue potential of a particular relationship.
And I'm sure you've already touched on this, but can you amplify your testimony on what role new technology and third-party providers of independent, standardized assessments of respondent banks' compliance with global standards might have on de-risking?
Sure. Today there does not exist a global benchmark. It is, frankly, what we're creating at Sigma Ratings. And the relevance of this is that if there is a global standard and there is one tool that is used to conduct initial due diligence that provides a baseline for correspondent banking, for correspondents to actually look at their respondent relationships, this standardization will allow them to have a starting point from which they can then do additional due diligence. So today, the way that it works is that these respondent banks have a number of correspondent banking relationships, sometimes, in 10 to 20 correspondent banking relationships. And they're required to provide the same information to each of those over and over and over again. And then each of the global banks or the regional banks are then required to review all of that information individually and provide their own risk assessment. If there is a standardized approach that provides a baseline risk assessment on all of the respondent banks or potential respondent banks, then each of those global correspondents can start from that point and then do additional due diligence on top of it. It would reduce the redundancies that are happening across the entire system, and it would also allow for banks to focus their time and energy and money on real risk.
And in my time remaining, back to my question to Mr. Lewis, what would a safe harbor on SARs look like? How might this platform that you all are creating limit the number of superfluous or unnecessary SARs?
Thank you. I think what Ms. Haddott's company has done is excellent. I think it's a great start, and it's a direction. And any information is good information. The question, of course, is how expensive the utility. But certainly, I think any information is good information for us to have. But how much is that information going to cost us?
Gentleman's
time has expired.
Has expired. Votes have been called, but we're going to try and get, we have two witnesses, or two questioners yet. So Mr. Green from Texas is recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well, and I also thank the witnesses for being here today to discuss de-risking, which is another way of saying closing accounts. And these accounts are being closed to avoid legal liability. And by the way, there's nothing wrong with avoiding liability. I think that it's perfectly appropriate that you avoid liability if you can. The question that I have has to do with the NGOs that are trying to be of help and that are finding themselves without the means by which they can transfer large sums of money to people who are in need of the help. That's doing good, but running into obstacles that are just not appropriate sometimes. So my first question is, to what extent does this problem exist? I've talked to at least 2 NGOs. There may be many more, there may be just a few. But to what extent does the problem exist as it relates to NGOs? These are non-governmental organizations.
Congressman, as a colleague of mine has said, we have been admiring the problem. We know that there is a problem. 2/3 of all U.S. charities, NPOs, are facing financial access difficulties. And that has a very serious impact on their ability to be able to transfer funds for humanitarian and development assistance. Part of the problem is that it's not just closing of accounts. And that's one of the reasons why, going beyond de-risking the term, we talk about financial access, because in the case of nonprofit organizations, delay and denial of wire transfers are actually a very serious problem. When it takes 6 months to provide fuel for a hospital in Syria, the situation is obviated. When it takes so much time to actually get the bank to provide permission for the wire transfer, the assistance is thwarted. And in that regard, the utility, the technologies that we've been talking about, KYC utilities, can actually provide a significant path forward. And that is because of the repeated request for information. The same charity and gets repeated requests from the same bank for the information. If we're able to create a utility where all of the MPO information resides, financial institutions can actually go there, get all of the information about their internal compliance, their due diligence procedures. And that is a repository or a KYC utility for nonprofits is something that the World Bank and ACAM process is exploring.
It's ironic that you would mention the example that you did, because that's exactly what was called to my attention about the delay, that it was taking what was thought to be an inordinate amount of time, an unusual amount of time to do something that was thought to be relatively simple. But again, I understand that it's happening, but is it happening to a large number of entities, 10%, 50%, 20%, just a guesstimate?
The study that was conducted and released last year found that 2/3 of all U.S. charities, NPOs, are experiencing these problems.
2/3?
2/3. And that was surprising.
Okay.
It was extremely surprising. And I would just say, with regard to the problems that are experienced, account closures represented only 6%. Refusal to open accounts was about almost 10%. But the transfers delayed was 37% of the charities that were actually surveyed. So that kind of delay, fee increases, et cetera, are really posing very serious problems for the provision of important humanitarian and development assistance.
Ms. Yearwood, do you have any additional comments on this?
The only comment I'd like to add is that this isn't only a problem for charities. I can cite at least one Caribbean government that could not get a bank account for their embassy here in the United States. And so this doesn't only have implications for charity, it has implications for diplomacy.
Well, thank you very much. Mr. Chairman, thank you for the time. I do have another question, but I think it might go well beyond my 12 seconds, so thank you very much.
Gentleman yields back his time. With that, we go to the gentleman from North Carolina, Mr. Pittenger, who is Vice Chairman of the Terrorism Financing Committee. Recognized for 5 minutes.
Thank you, Mr. Chairman. Really appreciate each of you being here today. I know you make a great effort to do that, and your knowledge is very much appreciated. I would like to just address to a greater extent further discussion issues related to the cumulative effects of the AML, CFT, and risk management compliance on financial service industry. Just, Mr. Lewis, if you could, please just give me some impact of the account of this terminations by this de-risking.
Thank you very much for the question. I think from my perspective, UNFCU, we have one very, very significant example of this, and that would be, and we have several, but that would be with regards to international remittances through Dodd-Frank and through the Bureau's ruling and rules. We had to basically change our entire remittance business. We were able to originate remittances ourselves for our members, but then certain requirements came into be with regards to disclosures. One disclosure was all the fees that would be taken out. Problem is we don't control that transfer. So if there's a transfer going to Asia, it may go through a correspondent bank in Europe and then through a correspondent bank in Asia, and they may take fees out of that. So what we had to do, because we couldn't do that, we had to go to a third party to do that. And what that ended up doing is it ended up increasing the expenses for our members because we had to go to the third party. In addition to that, it ended up consolidating the industry because what you had was many credit unions have gotten out of the business of remittances because they simply can't afford the technology and they can't track it as well. So you have this consolidation which increases fees and costs. And then on top of that, as I was saying earlier, on our technology side, in order to do that, it was $1 million. So that's just one small example of what we endured with regards to one specific type of regulation. And I know the credit unions across the board are experiencing similar situations. We as credit unions don't really fire customers. We don't have the luxury, if you will, to do that. The best we can do is we can't terminate an account without a very, very long process. So the best we can do is restrict services. But it is a real issue and a real problem for credit unions.
Thank you, sir. Sure, Ms. Eckert.
Mr. Pittenger, in terms of additional monitoring compliance costs of AML CFT regulations, some have placed it at $4 billion annually. One bank reported that over 4,000 additional compliance staff in 1 year were hired at a cost of $1 billion. In 2016, the Association for Certified Anti-Money Laundering Specialists surveyed their members and found that 3/5 of the respondents cited enhanced regulatory expectations as the greatest AML compliance challenge. So these are real costs. No one's saying that it's solely due to that, but it is among the most frequently cited causes of de-risking or financial access difficulties.
Thank you. Ms. Eckert, let me address the issues related to law enforcement and national security agencies and their ability to track financial activities of potential criminals. Does de-risking make it harder for them to do that?
I would say absolutely, sir, because as charities and other de-risked communities have to find alternatives, they go to unregulated money remitters, they go to hawalas, they go to places where they are not transparent or traceable. And that is contrary to what our money laundering and terrorist financing regime is all about, and that is responsibility of financial institutions and others, and traceability and transparency. So I think that the negative implications for counterterrorist initiatives and security overall are quite significant.
Thank you very much. Mr. Clements, I'd like to ask you if you just speak to the specifics of what impact communities face when banks, as well as bank branches, close up or move away due to de-risking.
There's a variety of challenges for the community. Just for the consumer angle, the consumer is going to lose that access to the service. On a broader economic scale, you're going to have less business lending, which then will ultimately flow down into lower employment, lower wages would be some examples.
Thank you. I really cannot ask another question without having enough time. Thank you.
Gentleman yields back. With that, I want to thank the witnesses for being here today. I'd love to follow up a little bit more here, but we've got to rush off to a vote. Without objection, all members have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witness to please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And with that, this hearing is adjourned.